What's up, guys? Welcome back to 10 Baggers, a channel for discussion about growth stocks and contrarian investing. In today's video, I'm going to go over the 4 advantages personal investors have over mutual fund managers. 1. Personal investors don't have to make investments for a living. A mutual fund manager's job is to make investments for his fund. When the fund becomes big enough, the fund manager begins to get analysts beneath him. The analyst's job is to research companies and make recommendations to the fund manager about which companies to buy. I could imagine being in the situation of being a young analyst and feeling like you aren't doing your job if you don't make recommendations for the fund manager. This leads to less than strong conviction investments being presented from people with different long-term visions for the fund and each company. Ultimately, it's up to the fund manager whether or not he makes the investment. But how can he explain a fund that's doing poorly when he isn't actively buying and selling stocks? It would appear to investors that the fund team isn't really doing their job well, and they will leave the fund. This, of course, doesn't apply to all funds, and there are some out there who invest in a few companies with strong conviction. Unfortunately, these funds are not easily traded by normal investors, and unless you are a extremely high net worth individual, or Claude from Switzerland's nephew, you ain't getting into these funds. And that's a good thing because the fees for individuals who invest in these types of funds is absolutely disgusting. Ultimately, the necessity to not have to always make investments means that you can wait for the opportunities that you feel strongest about investing in. And guess what? You have no boss to answer to about doing it or not doing it. 2. Personal investors don't need to diversify as much. Personal investors have the ability to focus their capital into a few investments. Let's say you have a portfolio of 5 extremely strong companies with excellent future prospects across multiple industries. Investing legends like Charlie Munger and Warren Buffett say that this is enough diversification for the average person with investing ability. The real downside to this approach is that the less stocks you own, the higher the potential is for volatile swings in your investments. It's actually not that hard to pick great companies to invest in. What is actually hard, though, is buying them at the right price and holding them for long enough to see a meaningful return on your investment. You need to have the personal gumption to be able to hold stocks through tough times, and the truth is that many investors have proven to be unable to do this. When you're throwing money at this stock and that stock randomly because you saw it on a Reddit thread that it was a good stock to invest in, are you going to be able to hold it through a loss of 50%? Probably not. But what if it's a company that you actually know and understand and you see and use every day? It's an investment that you research their balance sheet and you see that they're very unlikely to go out of business. What if it's a company that does all those things, but also has a visionary leader that you really believe in to innovate for the future? Yeah, you're much more likely to not only hold the stock through tough times, but perhaps even have the balls to get investing in the company during down periods. One reason I believe why index funds have become so popular among investors is that it greatly reduces the monthly volatility for the average investor. In this way, they are much more likely to hold on to the index fund for long periods of time and experience the beauty of compounding returns, even if they are leaving some returns on the table by not investing in individual stocks. Think of it like this. When you buy a house, it's kind of like buying a stock. You're making an investment. However, there aren't visible daily swings in the value of your home. And the average investor is confident that the long-term trend for real estate is to appreciate. It wouldn't be very likely for a homeowner to try and sell their house just because the value went down. In fact, much more often I see people trying to hold on to real estate during down times so that they can sell it when it comes back up. You need to think like this when you're investing in stocks. You aren't really buying a stock. You are buying an actual company. And just like a house, an actual company doesn't have visible swings in daily value. Only their stocks do. So as long as the company is going to be more valuable in the future, just like your house, you're making a good investment. Don't let the daily volatility of a stock shake you out of your shares. 3. Personal investors do not need to outperform the S&P benchmark. One of the ways that investors judge mutual funds is by their performance against the S&P 500, which just tracks the biggest 500 companies in America. If a mutual fund underperforms the S&P benchmark for 1 or 2 years, it's going to cause a lot of the investors in the fund to second guess their investment and begin to search for greener pastures. When you're a personal investor, you have no benchmark to answer to. It's your money. You might be investing in a company that you feel extremely strong about, but it's in a downtrend for reasons that are out of your control, and maybe it's an overreaction. This is definitely going to cause your investments to underperform the benchmark in the short term. Think maybe 1 to 3 years. But that's okay, because investing in stocks isn't a 1 to 3 year practice. The stock in a downtrend might end up giving you a return in the future of 50 times on your money 10, 20 years down the road. The real money is made in stocks from holding long-term investments. It's like Charlie Munger says, if you aren't willing to see the value of your investment go down by 50%, then you aren't fit to be a common shareholder. There will definitely be years where every investor underperforms the market. But as long as you have the ability to navigate those periods emotionally, you have a real opportunity to make money investing in stocks. And reason number 4, personal investing has never been as accessible. There has never been a better time for young investors to begin the endeavor of investing in stocks. The banking industry has basically eliminated fees, and many platforms like M1 and Robinhood offer fractional shares, which is the ability to invest in any amount of money into the most expensive stocks on the market. For example, if you only have $100, but you want to buy shares of Amazon stock, you can. Also, some fund managers think that the popularity of blind ETF investing has led to a decline in the act of price discovery in the stock market. This means that there should be buying opportunities in companies that are underrepresented in the indexes. I personally believe in a hybrid approach to investing. The average investor should be an investor in both broad index funds and individual companies, not one or the other. This ensures that the investor is getting best of both worlds in the investing world. They can make great investments in companies that they feel strongly about, and they can also grow with the American economy. I hope that you found this video informative, and let me know in the comments if you have any questions about investing in the stock market, and I'll try to make a video on that topic in the near future. Please do me a favor and smash the like button, as it will help me with the YouTube algorithm and help me reach more potential investors. Until next time, good luck bagging.